Hello, everybody. My name is Rob Hughes. I'm a partner in our agricultural business consultancy operation, and I'm based in our office in Kings Lynn. And I'm joined today with my partner Phill Dunn, who is a partner in our Brig office in North Lincolnshire. And we're going to talk to you today a little bit about strategic financial planning and the importance of it in today's agricultural world. So, Phill, might be a good idea if we try and define what strategic financial planning is.
Okay, Rob, thanks. Yeah, it covers a multitude of sins, but I think really if you call it strategic business and financial planning, it's really how a business manages itself financially to ensure it meets its goals. But of course, first, you need to have some goals, both short, medium and long term. And I'll throw it back to you, Rob, really. Why is this so important right now?
Well, I guess it's always important, but at the moment it feels like we're in a period of fairly tumultuous change with the industry, aren't we? And whether that's generational change, political or economic interference, loss of subsidies, or the gradual transition through the reduction in BPS, huge commodity price volatility, all these things are creating a certain degree of uncertainty in the industry, and the need, therefore, for some solid thought processes about how we're going to behave financially and from a management perspective has probably never been greater in terms of that context, really. But for how do we set about dealing with all those uncertainties and trying to get our heads around the implications of that volatility, because it's quite an off-putting environment to begin to analyse, isn't it? Because we're not really sure where everything's heading. So how do we actually do it?
It is a big topic, Rob, but I think the word planning is what it's about. So it's really essentially looking forward at what you perceive is going to happen in your business by means of a budget, really. And then importantly, as you go through that period, monitoring it, so putting actuals against budget performance. That gives us an idea of where we're likely to be and what our business direction is and the economic returns from it. From that, we'd usually construct that budget to represent all the different enterprises of any business at sort of gross margin level, then post-operational margin levels, that's after labour and machinery costs, and then net margin, which ultimately is the important figure. And that needs to be done for all enterprises and be realistic with it. So accept the constraints and liabilities and the strength of the assets underlying in the business. That will then either generate profit and loss or cash flow projection, either are fine. From that, we can look at the rate of return of income generated from the capital assets within the business. We can benchmark it against other businesses and probably more importantly against your own business year on year. Lots of KPIs, so key performance indicators from that. So pounds spent versus pounds generated, etc., etc. And then ultimately, you've got to measure this against your time available and the level of risk that you want to incur in your business. So those are the sort of tools of how to undertake financial planning. What would we expect as the outputs from that, Rob?
Well, what we're trying to do is create an environment where we make strong decisions, isn't it? So that fundamental tool is just a tool, isn't it? It's not always the answer. It's the basis on which we then amend or continue with our current course of action and current behaviours. So the budget will describe what the business might look like in a year or 2 or 3 years' time. But it's using that information then, isn't it, to make informed decisions about the future direction of travel, whether the existing strategy is cohesive and sensible, or whether actually there are some fairly key fundamentals, given the volatility and uncertainty regression of BPS, which is going to hit everybody's P&L account pretty hard. How we quantify the change of behaviour that we all probably accept has got to come about with the industry over the next few years. And also, I think it gives us a really strong foundation to make informed decisions about taking advantage of opportunities, because there's going to be some quite significant opportunities, we all think, that come about as a consequence of change. But they won't necessarily always be either profitable or cash remunerative. So having that analysis, having that clear financial strategy that's bought into across the generations of the farm, gives you opportunities to grow and expand and take advantage of opportunities, as well as sometimes look at slightly more rational thoughts about future direction of travel, retirement, whatever it might be. So it's all quite important that we put it, then we do the work, but then we put it into the context of what it is we're really trying to deliver.
Okay. That's great, Rob. I think really, to sum it up, the difference between bad and good has probably never been as wide, and that's a good reason to look at your own business and plan effectively. The economics of a business, to me, are simple. If you're to improve that, you either produce a greater output, or you do it at a lower cost, or you do more of it, or you do something different, and it might be a combination of all of those. And hopefully that sums up that topic of strategic and business financial planning. Thanks, Rob.
Thanks, Phil.